All right. Welcome, everyone, to today's daily macro update for Tuesday, January 20th. Apologies for the delay here. I'm actually on the road, so I had a little bit of a technical difficulty there. Not able to show the camera here, but we'll get into the markets. Let me change the view. There we go. Perfect. All right. So a little bit of a sell-off here in the markets today, and a little bit of a sell-off there in Bitcoin as well. The dollar, the Mag 7 stocks, all of which continue to point towards more of a risk-off environment towards hard assets like platinum, palladium, gold, silver, as well as some cyclicals. But this is mainly due to the manifestation of the fiscal dominance cycle that we're in currently. And so when I say fiscal dominance, what I mean by that is that the massive amount of government spending that's happening right now is what is controlling the bond market. It's not the Fed controlling the bond market, right? For those who are in the chat, if you guys can hear me, put a 1 in the chat just to make sure. I want to confirm that I'm reaching everybody here. But so this sell-off here is mainly due to the market finally realizing, hey, because of the fiscal dominance cycle that we're in currently, this is flooding so many treasuries into the treasury market, into the bond market, and there aren't enough buyers that it's causing demand to go down and yields to spike. And because of this, the Fed is actually choked. It cannot lower rates any longer. And it's kind of this catch-22 where the government, Trump, he really wants the Fed to lower interest rates, but because rates are so high that they have to fund a lot of their government deficit spending with issuing a bunch of bills, that in and of itself is causing inflation to remain high, and in turn making the Fed do its job with keeping rates higher for longer. And so we're back again in this cycle that we've been in since the pandemic, and we might be in a position now where the Fed might not even cut rates this entire year in 2026. So that is really the point that we are at here. And the market may just be figuring this out as a serious thing, right? And when I say that, I'm meaning that the market is just saying, okay, actually, we might not get the 1% Fed funds rate that we really want, and that this is actually a serious problem here. So that doesn't mean that there won't be any bull markets, right? We still have huge bull markets in things like silver, gold, platinum, as well as palladium, right? So all these hard metals, it's a flight to hard assets right now. The safety is not in dollars and dollar equivalents like bonds. The safety is in things like metals, hard assets, real estate, cyclicals, assets that do well when the dollar is essentially crashing. And so what's interesting too is that even though this dollar debasement is happening as well, at the same time, we are getting a rise in monetary inflation with, this rise in bank reserves that we're seeing. We are not seeing a rise in Bitcoin to what's usually expected during these times, right? I mean, it has had a little bit of a spike here, but all the gains that have happened pretty much since the beginning of the year in Bitcoin have been effectively wiped out. And, we were buying Bitcoin around this area right here. We had that huge spike. We were selling some at the top end of the trading range in our community. And I still own some, and I was actually buying a little bit on this dip to see if we got a pop here. But because of where it's closing right now, I will no longer be a continued buyer of Bitcoin until we see some strength come back. And if we actually have a continued dip from here, it'll probably trigger my stop loss. And that's okay. I mean, again, we have a bunch of other things that are continuing to perform well in the portfolio. So it's not the end of the world, but I'm looking more so at this as a large macro signal, right? And so that is very interesting to see that there. And I think this is an area that a lot of new investors are not used to. And so we are just in a new era, right? This fiscal dominance is starting to really dig its claws into the market. So, and we can see this by taking a look at the target rate probabilities for the January Fed meeting, which is, I believe, next week in 8 days. There's a 95% chance that they're not going to cut rates, so they're going to keep them steady. And then when we take a look at the rate cuts throughout the remainder of the year, they have the first one in June, and then the second one all the way in December. And so it keeps on pushing out a lot of the rate cuts. And so as of right now, rate cuts are more and more getting pushed out of even the next 2 years, right? Because this goes all the way to December of 2027. And they even have the bond market is actually pricing in a 25 basis point hike in October of 27. So the market is definitely not liking this. And what this really points to is this chart here that I posted, I believe, when was this? All the way back at the beginning of November, which is this no landing stop go cycle, right? And in this no landing stop go cycle, which we've been doing since 2023 and will stop at some point due to a hard landing, we are now right now getting into this point where we've sold some, and we are underneath that, we're getting some higher inflation expectations, and now we're getting into this stop phase here where we get more of a hawkish Fed, we get a rate pause, and we have stocks drop, hard landing fears start to come about, and once we get signals of lower inflation expectations, then we'll go right back into that cycle of, it going back to bullish. And so we were trying to inch back into this lower inflation expectations, but it went right back to higher inflation expectations. And again, this was posted all the way back at the beginning of November. And so we're just going to continue to be in this no landing stop go cycle until something really breaks. Now, the good news is that this cycle has been going on since 2023, ever since the end of the bear market of 2022. And typically, the market can do well in this type of environment over a medium to long term, which it already has proven that it's done. So in this market correction, I would not become fearful. I would just be looking for different opportunities, Now, those opportunities might change based off of the current cycle that we're in, but that doesn't mean that it's doom and gloom. There's no bull markets out there. There are plenty of bull markets. And so, yeah, we've been highlighting a lot of these. Obviously, everybody knows about the bull markets in precious metals, but some of the things that people might not be looking at are things like industrials, which had a little bit of a dip today. I was buying some XLI. Another one is real estate, which has been having a pretty decent rise over the past week and had a little dip. So there's another one to buy. Materials, again. Healthcare, energy, and then the big one that has caught even myself and my team by surprise a little bit is this massive rally in consumer staples, which again, this is a huge risk off type of signal, but it's not a risk off in the sense of buy dollars and bonds, but it's buy hard assets and things that will hold up as the government continues to do their out of control spending. All right. So again, there's plenty of bull markets. I just named 5 of them, along with the one that in precious metals that everyone's already aware of. But that doesn't look like it's slowing down at all. Now, what's also interesting is that when you take a look at the ratio between growth versus value, so this is growth stocks, things like, the Mag 7, big tech, versus value stocks, things like Walmart, Costco, that sort of thing. You can see that growth stocks are bearish compared to value stocks, right? So take a look at this. Value had a nice little dip, and it continues its bullish trend. There's a 6th bull market that I just shared with you. And these are the things that you want to own. You want to own these bullish trends, right? And so looking at this in terms of the yield curve here, the yield curve over the past 2 trading days has had a massive jump with long yields rising and a continuation of this bear steepening effect. And what's interesting is that this came out of its twist move and is in more of a classic bear steepening, which if we take a look at what that really means, right? This is a reflation or growth rebound. Dollar's typically bearish. Credit spreads remain tight and healthy, which is true. Fed policy is dovish for now until it gets more hawkish. And the government is just blasting the deficits, right? What's interesting, though, is that the sentiment is more risk off instead of optimistic. And yes, we have small caps doing well, but not tech and crypto. And then we have staples actually doing well, and that's not bearish. So this is more of a bear steepening twist type of thing, but we'll see what happens from here. It could be an early indicator that we're going more towards some type of debt spiral. So you definitely don't want to own cash. Okay, but obviously a lot of people, especially on the mainstream media, were blaming tariffs, the tariff news, as well as the whole Greenland acquisition for the reason for the sell-off. But that's not necessarily true. It's mainly just the large spike in long yields. Right there you go, right there. It's funny. Ever since the Fed started cutting rates on September 17th of last year, rates have gone straight up, meaning that they're getting it wrong again. The bond market is when bond markets do the opposite of what the Fed is doing, that means the bond market is taking over in terms of what the Fed should be doing. And the bond market is saying, Fed, you're not doing the right thing here. So I guess we got to take over. So with this large spike in yields, that is too fast. That is up too fast, and the market is not liking this. And that's really what's going on, not the stupid Greenland thing. That's just a distraction. But we're going to go ahead and get into some comments here by the comment section here on YouTube as well as Instagram, and then we can get into any type of questions that you all might have. Let's go ahead and take a look at this one here. Sean, appreciate the viewership. That SPX gold chart you showed is at its lowest since March 2020. Do you see it breaking support? And if that happens, would the Fed step in with QE to prevent a recession? Historically, when it breaks, recession starts. Possibly, but the thing is that the S&P, the SPX gold chart, which we can bring that up here. This is not crashing due to, due to valuations coming down or a squeeze with profit margins. Where'd it go? Here we go. This is happening because the dollar is just getting inflated into oblivion. Whereas back here, during the 2020 crash, you had nominal prices in the S&P as well as the S&P 500 in terms of gold also crashing. We're not seeing that right now, right? So if I bring up a chart of the S&P 500 in comparison, and just let me blow this up here. All right, so here we go. We have the ratio in tickers. Let me make this a different color. Let's just go with red. And then we have the actual nominal price of the S&P 500 in blue. And so as you can see, back during 2020, you had nominal and real values in the S&P crashing together, whereas right now they're kind of doing the opposite. You did kind of have that all the way back during the tariff tantrum last year, but something happened here in August of 2025 where it's kind of had this divergence here, right? And what was the market pricing in then? The market was pricing in the Fed ending quantitative tightening and starting to buy bonds again, which has been happening. And so what is that another word for? Monetary inflation. Good question, though. Will small caps continue to perform in this environment? Yes, they will. What exchange/platform do you use to buy Bitcoin? If I'm buying spot Bitcoin to put into my cold storage wallet, I'll just buy it off Coinbase. I don't trade on Coinbase, though, because of the crazy fees. If I'm just looking to have Bitcoin exposure and I'm trying to just trade it, then I'll just use the IBIT ETF in my traditional brokerage account through Charles Schwab or Fidelity or whatever you like to use. That's what I would just use it to trade with. Copper still a good bet. Yep, copper remains in bullish trend. Yeah, globally, growth looks pretty good, even if it's due to deficits being blasted out. That's what I'm seeing here. But I'm going to be dropping a video here soon, kind of summarizing this as a short video. But yeah, I appreciate everyone's patience today. Just been on the road. Just a quick reminder, tomorrow we'll still have a live stream. I might be on the road again tomorrow for that. And then I will be completely out for Thursday, as well as next Sunday's wrap up, or I guess this Sunday's Sunday macro wrap up. So I'll make it up to you guys, though. The week I'm back, which is next week, I'll go heavy on the content for you guys. But I'll still be posting things on X. So if you guys want to follow me on X, just look up Johnny Zerdy. You can follow me there. But yeah, that's all I have for you guys here today. Let me know what you think in the comments below. Oh, also too, if you go on YouTube, we just posted, because yesterday I streamed our yield curve phase signals live stream, but for some reason when I did the live stream, the the audio cut out, and so I uploaded the actual rest of the training here. So if you just go to my videos and just go to yield curve phase signals, you can see the whole thing there. But yeah, so that is there. But I appreciate everyone for joining. Have a great rest of your Tuesday. Good luck out there. And I will catch you on tomorrow's daily macro update. Bye, everyone.